Okay, I'm just going to get started here, even though I think people are going to continue to join us. Today, we're going to have a session on cost allocation and understanding cost allocation. Welcome everybody to the session in our series of grants management trainings that we're holding here in Region 1 for all of our grantees. I do want to just give a little background on the concept of these trainings. They are a little different from the sessions that are put on by the national office and in other settings, because we're really looking for collaboration and looking for your participation in the meeting. We've found that when you ask your questions, working through those questions can be really beneficial to all attendees. And that's also the reason why the session will not be recorded. We want it to be a space where people can feel free to ask questions without, feeling.
We lost your audio.
I think because we're trying to mute other people so that I'm getting muted as well. Let me see.
You're muted, Trevor.
Yeah, I keep getting muted. I think because we're muting people as they come in. So, Suzanne, maybe you can stop muting people as they come in and try to just mute people individually. I think that that's the best approach. I just got muted again. So, basically, if somebody's hitting mute all, they're also muting me. So, and then if I can have everybody also turn off their cameras, it just helps with bandwidth. I'm on mute again. Let's see if this is a setting here. It looks like our settings are all set. Okay, so please just mute yourself and turn off your camera. That'd be much appreciated. And again, the concept of these sessions is to have them be more collaborative. That's why we have 2 hours and why I'm not, I'm fine with people kind of coming in a delayed fashion here without jumping right in. We should have plenty of time. But what I will ask is I do have to get through, the general concepts first. So, but I don't want you to kind of forget your questions. So please just put your questions in the chat. And when I get to the end of the content, I'll go back and go through all of your questions. So that's how we will deal with questions today, is we'll get to them at the end and I'll go through them all. And again, these sessions are not recorded because we want people to feel free to ask their questions and give their scenarios of the things that are going on at their particular organization without feeling that it's going to be recorded. So that's why we don't record these sessions. We can provide the presentation itself after the session, though. But again, if you have questions as we go through the content, please just put them into the chat. And then at the end of the content, I'll go back, go through the questions, and I may ask you to come off mute and turn on your camera to clarify anything that in your question. And then when we get through those questions, we can, people can ask other questions as well. Okay. So, understanding cost allocation. And one last housekeeping thing I'll say is please, if you have any grants management topics that you would like us to address through one of these sessions, please email your FPO and let us know which of those topics that you'd like us to do a session on. We do have, I'll just tell you now, though, that we are going to do a session on modifications, amendments. We're going to do a session on subrecipient and contractor determinations and also subrecipient management. We're going to do a session on match and leverage. We're going to do a session on question costs, a few other topics as well. So if you have any topics other than those, please let your FPO know. Okay. So our agenda for today, we're going to go through the uniform guidance. So I think it's always important to let grantees know where the rules come from and what they say. Sometimes you hear FPOs and other government officials say you must do something. Well, the reality is if we're telling you must do something, then it needs to come from somewhere in the law. It must be in writing. So I think it's very important to let you know, when we're telling you you must do something, where it actually says that you must do that thing. We're going to talk about the factors affecting allowability that's a component of allocability. And then, vice versa, allocability is a component of allowability. So we're going to go through those topics. We're also then going to go into the methods for cost distribution. So you have direct costs, indirect costs, and then shared direct as well. And then go into some common problems. So that would be, like common findings that we see, common issues with cost allocation. From my experience, it's great to hear all the content and technical information, but I think people really learn and their ears prick up when you can actually see what the common problems are that grantees face. And then you can go back and take those slides and make sure that your entity or organization is in compliance and doesn't have those common problems. My name is Trevor Capon. I'm a federal project officer in Region 1, but also do a lot of the fiscal and admin training for discretionary grantees. I have taken all the classes to be a grant officer and getting close now to 20 years of experience doing grants management and teaching grants management. My photo, yes, that's what we call in the business blue steel. It's also hard to see how jokes land when everybody's on mute, so I'm hoping there was a chuckle here or there. All right, so disclaimer. Cost allocation is not always a science. There's a little art to it. So what that really means is that it isn't, everything isn't always black and white. We have the principles, the tenets as our guide, but the best way to handle, understanding the application is to look at each scenario individually, and then you back into the regulations. You look at the regulations as your guide, and then you make a prudent person decision. It is hard to make up scenarios because, one little detail can change the answer. So I always ask for grantees, let's not speak generally. Let's look at the actual scenario, get all the details, and then we can go back and look at what the regulations say. And then it's going to take judgment. It's going to be that prudent person decision making. And finally, it's very important then to document your prudent person decisions. When we come and monitor you, if there's a questionable decision that has been made and there's really no documentation, we're much more likely to fall on the side of the fact that it may be a finding or an issue. And, so however, alternatively, if we come and monitor you and there's a decision that maybe is questionable, it could have gone one way or the other, but you have a memo or some documentation about, a prudent person decision making and how you arrived at the decision you made, we're much more likely then to, see it your way, as long as it's within the confines of the federal regulations. And so always important to document your decision making. So where do the rules come from? They come from the cost principles at 2 CFR 200 subpart E, and also the DOL exceptions to the uniform guidance at 2 CFR 2900. For those of you that are somewhat new to the uniform guidance and understanding grants management, basically there used to be a set of rules for nonprofits, a set of rules for educational institutions, and a set of rules for states and local governments. And on top of that, a set of rules by each federal agency. So there was a lot of inconsistency on how things were done throughout the federal government. And as a grantee, if you're getting grants from multiple federal agencies, or even for us when we were monitoring different entities, it was very hard to provide consistent guidance and to interpret the regs when, each entity had a different set of rules and each federal agency had their own set of rules. So there was a work group formed, and by 2014, they created what is called the uniform guidance. And that's really now we eliminated a set of rules for each type of entity, although there are a few legacy exceptions for certain types of organizations in the uniform guidance, but overall, the rules are for everyone. And then also the rules are supposed to be for every single federal agency as well. So that grantees, you get a grant from multiple federal agencies, there should be just one way that you're required to do it because, hence uniform guidance. There are nuances depending on federal agency. So we did have the opportunity, each federal agency, to submit to OMB some what we call exceptions. And in general, they're not, some I guess are exceptions, but more they're clarifications. So the DOL exceptions or clarifications are found at 2 CFR 2900. So I can just give you one quick example. When we the definition of a non-federal entity in the uniform guidance was nonprofits, educational institutions, states and local governments. At DOL, we also gave grants to for-profit entities as well. So we wanted to make a clarification that for-profit entities are also considered non-federal entities, because the uniform guidance uses the term non-federal entity throughout, to talk about grant recipients. So that's just a quick explanation there for those of you who are new to this. Then we have this slide.
Oh, there you are.
If somebody can just mute their
How are
phone,
you?
mute their line, that would be great.
Good.
Someone saying
Do you have a
good.
moment? I do. I do.
Someone saying I do. I do.
You're on mute now.
People don't people don't realize that we're that they're on mute, even when I say you're not on mute, without pointing out the things that they're actually saying. Sorry. Okay, so back to where do the rules come from? This part should be pulled off, the cost classification line here. I do have a separate presentation on cost classification, which has to do with admin versus program costs. So that'll be a different presentation. This session, we're focusing on cost allocation specifically, and the costs, and that the rules come from the cost principles. So that I just want to say, for the folks that are helping me mute, if you could from now on mute people individually rather than hitting mute all, because if you mute all, it mutes me and I may go on for a while without knowing I'm on mute. Let's see here. Okay, so in general, I don't like to read from slides. No one wants to sit here and just hear me read. However, I think it is very important when we're looking at the regulations to read exactly what they say. And the purpose of that, I've found that when people parse out what the regulations say or try to summarize it, they end up changing the meaning. And each, when they created the uniform guidance, kind of each word in each sentence was very thoroughly thought through. So to get through the actual regulations, I am going to do some reading here, so forgive me, but it's the best way to convey exactly what they say. And then we'll move into some more slides after that without the reading. So to start, so the cost principles, subpart E of the uniform guidance found at 2 CFR part 200.400. Say, so the application of these cost principles is based on the fundamental premise that the non-federal entity is responsible for the efficient and effective administration of the federal award through the application of sound management practices. The non-federal entity assumes responsibility for administering federal funds in a manner consistent with underlying agreements, program objectives, and the terms and conditions of the federal award. The non-federal entity, in recognition of its own unique combination of staff, facilities, and experience, has the primary responsibility of employing whatever form of sound organization and management techniques may be necessary in order to assure proper and efficient administration of the federal award. That's the opening part of the cost principles here. So then we have the factors affecting allowability. So you'll see that overall what we're getting at here are allowable costs, and that allocability is a component of those. So, but to understand allocability, we need to understand the general principles of allowability. So what it says is, except where otherwise authorized by statute, costs must meet the following general criteria in order to be allowable under federal awards. They must be necessary and reasonable for the performance of the federal award and be allocable thereto under these principles. Conform to any limitations or exclusions set forth in these principles or the federal award as to types or amounts of cost items. Be consistent with policies and procedures that apply uniformly to both federally financed and other activities of the non-federal entity. Be accorded consistent treatment. A cost may not be assigned to a federal award as a direct cost if any other cost incurred for the same purpose in like circumstances has been allocated to the federal award as an indirect cost. Then we have E, be determined in accordance with the generally accepted accounting principles or GAAP, except for state and local governments and Indian tribes as otherwise provided, not be included as a cost or used to meet cost sharing or matching requirements of any other federally financed program in either the current or prior period, must be adequately documented, and the cost must be incurred during the approved budget period. The federal awarding agency is authorized at its discretion to waive prior written approvals to carry forward unobligated balances to subsequent budget periods pursuant to 2 CFR 200.308E3. So that's exactly what it says on the factors affecting allowability. So then what are some of these components actually mean? So you see must be necessary and reasonable. What is a cost being reasonable actually mean? So what that means is, have you done an analysis that the cost is reasonable? Are you paying the market rate for a cost? It would be nice, what I say, that it would be nice to have the top of the line Mercedes van to transport your participants, but is that a reasonable use of federal funds? That getting back to the prudent person decision, is that what you would have chosen to purchase with your own funds? So what gets the job done in the most cost efficient manner? That's, gets at the heart of reasonableness. Just another basic example, is a cost reasonable? When you're buying a piece of equipment, we want to make sure that we're using equipment that our employer partners are using in the real world. We want our participants trained on the actual equipment that's being used. But if that's not a factor, do we buy the most expensive top of the line piece of equipment just because we have federal funds? That's not how we want to operate. We want to be good stewards of federal funds, and again, find the most cost efficient item that gets the job done. Is the cost necessary? So I have a couple examples here. Your program wants to buy a vehicle. What is the vehicle actually used for? How does the vehicle going to support the goals and objectives of the grant? If you're an organization that has a program where you have to do a lot of outreach to participants, maybe in rural areas, and you also need to get those participants to trainings, which may not be near where they live. In some areas, maybe the best way to solve that issue would be bus passes or other public transportation. But again, in a scenario where it's a rural area, we may need to purchase a vehicle. So, like the Youth Build Program, NFJP, we do see it is common for vehicles to be purchased to transport participants, but there is a necessity and it can be documented. And without that solution of the vehicle, the program can't even operate. Participants can't get to training. They can't get to to maybe your offices for testing or other reasons. Another example that I like to give, which I often give in my match presentation, but what you'll hear in the match presentation is match costs have to be allowable and allocable just like any other grant costs. So the example that I like to give is you have 5 staff and you've purchased them all computers for the operation of this federal grant. And somebody donates a computer to the program. You couldn't count that as match at that time because your participants all have, your staff already all have computers. If you held on to the computer and at some point, maybe the computer was necessary because somebody else's computer broke, at that time you could then use the computer and then count it as a match on the program. And that would be the same as a direct cost. If you already have 5 computers, you wouldn't buy another one because it's not necessary. The 5 staff already have computers that they're using. So more broadly, when we think of our programs, when you're thinking about incurring a cost and we're thinking about necessity, you're just thinking, is this going to further some deliverable of my grant? Without it, will my participants get trained or employed without the incurring this particular cost? Or will I be able to deliver on some, specific deliverable that was written into the grant without this specific cost? So necessity is a major factor of allocability and allowability. So we don't want to purchase things just because it'd be great to have them. They have to actually be necessary to carry out the federal award. And the final factor affecting allowability is it's in the selected items of cost. So this is, in 2 CFR Part 200.420, the federal government has listed very common costs in federal awards. Things like legal services, things like meetings and conferences, things that, it's a pretty extensive list, but it definitely does not capture all typical grant costs, but it's a kind of broad list. And it says if those costs are allowable, unallowable, or allowable with prior approval. So if I'm an organization and I'm trying to decide if I can actually incur a specific cost, you want to look at your program, right? There's a whole host of things that you need to look at first, but you can also then go to the selected items of cost in the regulations. And then we go through our general tenets of allowability that we just went over in previous slides. So now that we've kind of gotten through allowability and touched on a little bit of allocability, we're going to really dive into the allocability component of allowability. So allocable costs are defined at 2 CFR 200.405. It is a cost is allocable to a particular federal award or other cost objective if the goods or services involved are chargeable or assignable to that federal award or cost objective in accordance with relative benefits received. So that's the, I kind of wanted to mention it on an earlier slide, but, waited for the impact now. When we're talking about allocability and what, in necessity, it's really comes down to benefit received. For just at a base level, for a cost to be charged to a grant, that grant needs to receive benefit or some relative benefit during the budget period. If it's not going to receive a benefit during it's not going to receive a benefit of this cost during the period of performance, it is most likely not going to be allowable. So the standard is met if the cost is incurred specifically for that federal award, or it benefits both the federal award and other work of the non-federal entity and can be distributed in proportions that may be approximated using reasonable methods. We're going to get, some of this may sound like word salad, but I'm going to get into in later slides specifically what this means. But again, I just want to highlight that it can be just for the federal award, or a cost may benefit multiple awards or multiple, cost, multiple cost centers. But we're going to have to make sure that we allocate the benefit received amongst the different funding streams. And then back to our, favorite topic about necessity. So it has to be necessary to the operation of the non-federal entity. So, I'm often asked, okay, Trevor, it says relative benefit received. Well, what is relative benefit received? The allocability is the measure of relative benefits received. And to get at that, what it actually means, we have to kind of look at overall, where is our funding coming from? So, if you have a grant from HHS or a grant from the U.S. Department of Labor, the relative benefit received is going to be it may be different. And where we can track that back to is really what are the overall mission of the agency and this federal award. So we do have some programs that are just capacity building, but overall, most of our grants and our mission is to help people get trained and employed. So that's a good question to ask yourself when you're thinking about charging a federal award for a grant is, okay, is there a benefit to this grant? And okay, what does that actually mean? Well, in a DOL grant, if that's the mission to get people trained and employed, is this cost going to actually help somebody get trained or employed? So we have costs, throughout programs that may seem intuitively like they should be part of a program, but are not. There actually isn't a relative benefit received because it didn't help somebody get trained or employed. One example is like graduation costs. So the ETA grant officer has determined that graduation costs and related costs of graduation are not allowable. And the reasoning behind that, well, you may say, okay, well, our participants have gone through this program. It's natural to have a graduation of some sort but yes, the celebration is important, but it didn't actually help anybody get trained or employed. It didn't further any of the deliverables of the grant. Therefore, we ask that you leverage the costs of graduation. So there's no relative benefit received because, again, graduation isn't helping anybody get trained or employed. And that is part of the art of this, because that isn't written anywhere. It doesn't say that in writing. Relative benefit received for DOL is the question. Does it help somebody get trained or employed? That's an interpretation, but that is the overall goal of our grant. And then we go outside that when there's maybe a specific deliverable. So, we had the TACT program that was really focused on capacity building, and grantees were allowed to develop programs that no participants were going to go through in the period of performance. But they had a deliverable, like, we're going to create a new advanced manufacturing program from scratch, but we're going to deliver it, by the last day of the grant. So in that case, that would be kind of an exception. There, no one, if we're incurring costs to like curriculum writing, if you ask yourself, did it help somebody get trained or employed during the period of performance? Yeah, the answer is going to be no, but it is written into the grant as a deliverable. So therefore, the associated costs would have a benefit received. So I'm really just giving you kind of the art of it, and what's the general question that I can ask myself in an employment and training grant when I'm initially thinking about charging a cost to a grant? Is this cost going to help somebody get trained or employed? If you answer no, we're going to have to dig a little deeper. So I got into the cost supports the completion of some deliverable. Okay. So now that we understand the allocability concept and whether something is allocable, how do we distribute or allocate the cost to a particular grant or cost objective? So if we take like that vehicle that's, we've determined that vehicle is going to support the goals and objectives of the grant. It is going to help our participants get trained and employed. Now we have to say, well, do we charge the whole cost of the vehicle to the grant, or does the cost of the vehicle need to get distributed amongst multiple funding streams, because maybe there's benefit received to those other funding streams as well? And then we have some other methods that we're going to get into here as well. So we've kind of determined allowability. Now, what are our methods to distribute the cost? So our methods for distribution or cost allocation, we first have direct costs. So what are direct costs? Those are costs incurred for a single cost objective. They're easily identifiable to that single cost objective, and they benefit that single program. Then we have indirect costs. So those are organizational costs that don't directly benefit a grant or cost objective. They're costs incurred for a common or joint purpose benefiting more than one cost objective, and not readily assignable to the cost objective specifically benefited without effort disproportionate to the results achieved. So just to back up, to give you more in layman's terms, a direct cost, we can see that this cost, there is direct benefit received. We see that this cost is going to help somebody get trained or employed on that particular program. We see that this particular cost is necessary to complete some deliverable that we said that we were going to do in our grant. The concept of indirect costs comes from, if you take your typical organization that maybe is largely funded with grants, federal grants, that could even be foundational grants. When we're talking about benefit received, we have all those costs that we can directly allocate. But what about all the kind of more high-level organizational costs that don't directly benefit a particular grant, but are necessary to the operation of the organization. So like if you just to, a CFO, a CEO, the CEO or president, they're often considered indirect because they're not down, helping somebody get trained and employed. They're not doing intake of participants. But, without the CEO, the organization may not be able to function. So, or the really kind of basic example I give as well could be like the snowplow bill, for all of us in the Northeast. I know we don't have to deal with that in Puerto Rico and the VI, but for all of us in the northern states, our parking lot needs to get plowed when there's a snowstorm. Can we say that snowplow bill helped one of our participants get trained or employed? No, not directly. So that's not going to be considered a direct cost. However, our staff can't come to work and park, if the parking lot's filled with snow. So that would be something that's an organizational cost. So what the federal government decided is we're going to come up with this concept, this formula to be able to distribute those more organizational or indirect costs amongst the different funding stream. So everybody pays their share to help keep this organization functioning outside of just the direct costs that benefit our grant. So hopefully that gives you kind of the background. Then we have the shared direct costs. So those are costs incurred for common or joint objective. They're not easily identifiable, sometimes to a single cost objective. They benefit multiple programs. They're costs that can be traced, to a specific cost objective. For example, materials and labor. However, the proportion of the relative benefit received can be difficult to identify. So I'm giving you that definition, but I'm going to get into what it is a little bit more later. So direct costs, I think I gave you the general principle, but when you think about your SF 424A budget form, it's all the costs that are contained there, besides the indirect, obviously, that are in your budget narrative. And these costs directly benefit the grant. So the personnel, the people working on your grant, their related fringe benefits. Supplies that are purchased for this particular grant to help it operate. Equipment that was purchased for this particular award to help people get trained. Travel that can be of staff or participants that directly benefit this grant. Our subrecipient costs, contractual costs, and then we have other costs. Those are our direct. Indirect. So I kind of gave the concept already. We've kind of gone over this slide in my previous explanation. But I do want to just give you the exact definition. So it's those costs incurred for a common or joint purpose, benefiting more than one cost objective, not readily assignable, to the cost objective specifically benefit without effort disproportionate to the results. And it may be necessary to establish multiple pools of indirect costs to facilitate equitable distribution of those costs. Indirect cost pools must be distributed to benefited cost objectives on a basis that will produce equitable results. In consideration of relative benefits derived. And then for institutions of higher education, the term facilities and administrative costs is often used to refer to indirect. Although in the DOL world, administrative costs are not the same as indirect costs. There may be overlap, but they're not the same. Let's see. And then so I gave some examples, the CEO salary, an HR department, an HR department that it's hard to say that the entire HR department is benefiting an award that was specifically to help people get trained or employed, but they did have to potentially hire staff for that program. Um, they may not have needed to hire any staff for that program at that time, but to support the HR department, it needs to exist potentially in a larger organization. Um, so that's something that's often funded through indirect. Fiscal department is often funded through indirect, and then I give that kind of more hyperbolic example of the snowplow costs. And then how are they allocated? So through an indirect cost rate agreement. So that's an agreement that's negotiated with your cognizant agency, meaning your agency that gives you your most amount of funding. Or we've gone to the use also alternatively of the de minimis rate. So let's we'll get into that a little bit more here. So what is an indirect cost rate? So it's a ratio expressed as a percentage of an indirect cost pool in some direct cost base. And the rate is improved by your cognizant agency. And then here's an example. So you negotiate your indirect cost rate agreement with DOL, and they give you an indirect cost rate agreement, and it says that your indirect cost rate is 17%. And then your base, so what you're going to multiply the 17% by, just for example, salaries and fringe. So as an organization, if this is your indirect cost rate agreement, you would look at your budget and you would look at salaries and fringe, multiply it by 17%, and that would give you the budgeted allowable indirect for the life of the grant. You know, your base salaries and fringe could potentially go up or down throughout the life of the grant, and that would affect your base. And so the overall amount that you end up charging may end up being less, or it may end up being more. Then we have the de minimis. One important note that I just want to quickly mention is that the de minimis rate did go up from 10 to 15%, but that's for grants that were awarded on or after October 1st, 2024. And then also the corresponding definition of modified total direct costs. There's a component that went up from $25,000 of each subaward to $50,000 of each subaward. But again, that's only for grants that were awarded past October 1st, 2024. So unfortunately, that could mean you have a grant, an older grant awarded before October 1st, 2024, and you need to use the old rate and base, and you could have a grant awarded after October 1st, 2024, and you're using the higher rate and potentially higher base. So just keep that in mind. One thing I want to mention is the de minimis. People often say the de minimis rate, but it's actually a formula rather than just a rate. So the rate part of the formula is 10% or 15%, depending on when your grant was awarded. But then we need to ask, I'm just going to go with the old definition so I don't have to keep going back and forth between the 10 and the 25. Although I see I have 10 here, but then I changed it to 50 here. So we'll just say that where it says 50 grand, let's call that 25 for right now. I should have updated the slide here. But basically, so we need to ask 10% of what? So the de minimis is 10% of total modified total direct costs. And if you want to know what the definition of modified total direct costs, or MTDC, you need to reference the uniform guidance, and that's found at 2 CFR Part 200 in the acronyms and definitions, and then you search for the modified total direct cost definition, and here is the definition. And actually, this is the current definition. However, again, the old definition, this would say 25 thousand here, but what it says, it means all direct salaries and wages, applicable fringe benefits, materials and supplies, services, travel, and up to the first old grant, 25,000, new 50,000 of each subaward, regardless of the period of performance of the subawards under the award. Modified total direct cost excludes equipment, capital expenditures, charges for patient care, rental costs, tuition, remission, scholarships and fellowships, and participant support costs, the portion of each subaward in excess of old definition 25, new 50. And then other items may be excluded when necessary to avoid a serious inequity in the distribution of indirect costs, and with the approval of the cognizant agency for indirect costs. So it's not 10% of your approved budget, it's 10% of the modified total direct costs. So in the indirect section of your budget narrative is where you need to demonstrate the calculation. So what you need to do is look through the direct costs in your budget and then remove the things that aren't included in the base based on the MTDC definition, and also only include the first, if it's an old grant, 25 subawards and the new 50. And then when they have all the things that should be included, you list them, add them up, and then that gives you the number or base that should be multiplied by the 10%, or in the new definition, 15%, and that gives you the total indirect for the period of performance. And then that number is shown in the indirect section of the budget narrative and put on the indirect line of your SF424A budget form. So here's kind of a, an illustration of what I'm talking about. So here is a grantee's general budget. They have 10 grand in personnel, 5 grand in fringe, $500 in travel. They have some equipment costs, supplies, contractual, some rental costs and tuition. So you would pull down into your indirect section. If you're using the de minimis and modified total direct costs, you would pull down your budget into the indirect section of your budget narrative and then show us what is being included in the base and what is being excluded based on our definition. And you see here it says we need to exclude equipment, capital expenditures, patient care, rental costs, tuition, etc. So here, equipment, that's an excluded item. That's not going to go into our base. We have a subaward that's $1 million. In the old definition, we're only going to count 25 grand of that. Then we have another subaward. In the old definition, we're only going to count 25 grand of that. Rental costs, that's something that's excluded. So we're going to exclude rental costs. Tuition, that's something that's excluded. So that comes out. And then that gives us our total allowable base is 67,500. Then we're going to multiply that by the 10%, and this is using the old definition. And then that's going to give us the amount of allowable indirect that we can charge for the life of the grant as a budgeted amount. So again, if something changes in the base throughout the life of the grant, your base is changing. And therefore, the allowable indirect could go up and it could go down. You could end up saying, you know what, we didn't actually need one of the people that we were going to hire under the grant. And so we never hired them. So we only had 5 grand in personnel and 2,500 in fringe. So that means that your allowable base went down, regardless of how much you budgeted. So that was indirect. And I know the concept of indirect can be confusing. There are resources on the DOL website where, there's a class or a session just on indirect. And hopefully I can do a session just on indirect. But the aim of this presentation is just to give you kind of the overall concept. So if you don't 100% get it, don't, don't fear. We can address it in more detail in later sessions. But for budgeting purposes and just understanding cost allocation as a concept, these slides should be adequate. Next, we have shared direct costs. So this benefits multiple programs. There needs to be a allocated base on either the actual cost or an acceptable shared direct cost methodology. And some examples of those would be the number of participants served, number of FTE, square footage used by the program, which approximates the actual cost. So let's just back up. If we take a individual that works on multiple grants, for example, they're benefiting those different grants. So there are two ways to allocate that person's salary in fringe and corresponding indirect. And they can either keep track of their time down to the, reasonable period, hour or whatever, on the way, which grant they worked on through like a personal time and activity record, or, almost like a lawyer would. I'm working on this case for this number of hours. I'm working on this grant for this number of hours. That's the most acceptable way to allocate time of somebody working on multiple grants. But it is also acceptable, when we have somebody that's jumping around in one day from this grant to that grant, it can be very hard to determine how much time it was actually worked on each. And there can even be activities that the person's working on that benefit multiple grants. Like they go to a WIB meeting and, lots of different grants and programs were talked about. How do they, really allocate the time spent there to the different awards? And so the alternative to keeping track, down to the minute or hour, whatever period, is to use a shared direct cost pool. And basically, you would take that person's salary, corresponding fringe, or an indirect, put it into a pool, and then it's going to get allocated or distributed to the different programs that benefit from that person's work through a methodology that best approximates if the real amount, like if they had actually kept down to the hour, minute, or whatever. So we have to look at what methodology we use for distribution, and it should kind of align with what we're doing. So if we're talking about a program manager, number of participants in a particular program, that might be a good way to approximate the benefit received. The more participants, the more time this person had to work on that grant. That's the concept. If we're talking about like energy costs, if those aren't going into indirect and you are, say direct charging, like the usage of your electric bill to different programs, how do you know how much electricity each of these programs is actually using? But one acceptable methodology for approximating that would be to use the square footage. So how much square footage of your building is each program using? And if the more square footage they're using, theoretically, the more lights, the more energy use. So that's the concept there. We cannot use size of award or available funding as a cost, as a base for distribution. So that it's kind of like, just because, I hear some people say, oh, well, we purchased the printer or copier with that award because it was a new grant and it had a lot of money in it. And, this other grant was spent down, so there's no money there to buy the printer. that's a red flag for us during monitoring and auditors. You can't allocate based on available funding. It has to be based on the benefit received. So, yeah, keep that in mind. In WIOA, a common example is like common core services, like intake. You may have somebody that works the front desk of a career center or even the front desk of an organization that has multiple programs. And somebody walks through the door, they send them over to this program, they send them over to this program, depending on their interest or, their background. But it would be very difficult for the person working the front desk to keep track of, what grant is benefiting from their time. So they're commonly put into a shared direct cost pool, and then number of participants in a program is used as the distribution method. And what the regulations say is that we do have to do some testing periodically to make sure that the methodology we're using does approximate the actual, if we were doing it more like the lawyer down to the minute methodology. So, if you're using square footage for a long time for a particular distribution of cost, you might want to take a look at for some period, a month or two, and doing it more on the direct basis based on actual use. You can't really do that with energy costs, but there could be other costs that would fall into that category. And then you can say, okay, well, we were using the distribution method, we were consistently charging X. We found, that it is commensurate with if we had charged the actual cost to each program. So we can continue to use that distribution methodology. If it comes out very, different, there's a big gap between the two. Maybe you need to look at a different methodology. So let's see. I think we kind of talked about that. Staff working on multiple grants. A vehicle, if it's used and shared by multiple programs, that could be just you have a log sheet and it gets signed in and signed out by those multiple programs. And that is like the kind of best way to distribute the cost based on benefit received for the vehicle. But you could have a vehicle that's operated by a driver and they pick up participants for this program and then they drop them off at training. They pick up participants for this other program and they don't necessarily know what programs they're just doing what they're instructed. So we might take that vehicle and the driver's costs and put them into a shared direct cost pool and then allocate their costs to the different grants based on the number of participants that are in each one of the grants. So we talked about utilities, space that's used by multiple grants. That was one that maybe you would use participants. So what is the best allocation base for shared direct? There is no single answer. It varies on the type of organization, the type of cost should relate. So I already mentioned that, we're with the program manager, we're using participants because that's that's what it relates most closely to. Energy costs, we're using square footage because that's what it relates mostly to. We talk about like audit costs. That's actually the one example, if the audit costs aren't charged to indirect, that it's like the one example we can use size of award as our allocation base is for audit costs, because auditors spend more time on larger grants. So therefore, our distribution methodology relates to the cost that's being allocated. And we've looked at some of these already. So counting, number of transactions, auditing, counselor, direct labor hours, number of participants. So I kind of hit on this already, but here's some examples. And then I talked already about the reconciliation. So that's when you do that periodic review of the methodologies to make sure that they're still appropriate and fair. And then, yeah, so you use for a period, you distribute the base on the actual cost and then you compare it. So we talked about that. And we've already even hit on some of the common problems, allocating based on available funding. That's a no-no, can't do that. Using an inappropriate allocation base. And then allocating based on budget. So I want to stop and talk about that one. That is a major issue. When we monitor and we see grantees and they've, in this grant, they've budgeted 15% of someone's time. And in this grant, they've budgeted 20% of someone's time. And then we look at their time records, and every single period, they're charging the exact amount of their salary to each grant based on exactly what was in each budget. That's a red flag, because grant management doesn't work that way. 1 week you may have to put out fires in this grant and you're spending more time on that grant. In another week, you're working on this other grant more heavily. Like, time distribution goes up and down for people that work on multiple grants. It may be a ton of work up front because they're getting it off the ground, and then they hand it off to other people, and it's kind of cruising for a while, and then there's more activity when they have to enroll participants. So when we see that you're allocating based on the budget, that can be a finding, and is usually a red flag for auditors. There can be some exceptions to that. If you're going to allocate in your budget, or say budget 15% of that person's time to our grant, and then the rest of their salary is paid for with your own funding or unrestricted funding, and they're most likely going to be working more than 15% on our award, and you're just picking up the difference, that's when it can kind of be okay to just kind of follow the budgeted amount, as long as it's 15% over of their time that they're actually working on the grant. But in general, they need to be allocating based on the actual time worked, regardless of what the budget says, and that's fine. We understand that. A budget is a budget. It's a planning tool. You might say, we're budgeting 15% for this person, but then you figure out DOL reporting requirements, and you're like, oh, actually, that person's going to have to spend a lot more time than 15% just figuring out how to report. So that's fine. You can charge that time above what you budgeted. And then, when we get into the modification and amendment section, there's some flexibility, 10% of your award for moving money. And that's your cushion there when your, staff time is more than budgeted. But you don't want to just allocate based on budget. So that's really the presentation. So here are your resources and my contact information, although I do ask that you go to your federal project officer, and then if they can't answer, they can consult with me. And I can leave that up, but let me just now take a look at the chat and see if we have any questions. So, chat. Okay. Just asking about if it's going to be recorded. So we don't record it. And also we don't use the AI note taker, so somebody did remove it. Thank you. And again, we only don't record these sessions because there is a cost allocation presentation that exists on the DOL website that is from the SMART training that's very good. And that is actually recorded. But in this forum, we want you to be able to ask questions without, thinking, okay, if I ask a question for my organization, is it going to now be recorded that I did something potentially wrong? We want this to be a safe space to learn, and we want you to be able to ask your questions. So getting into some of these questions, someone asked, does a list of unallowable costs that we can reference exist, like graduation and others? So there isn't a list of costs that are unallowable. Besides, if you look at that citation that I gave you earlier for the cost principles, the selected items of cost, there are some costs that are patently unallowable. One is, for example, is alcohol. There's really no exception. Maybe in some foreign service, but in general for grants, alcohol unallowable. So there are some costs like that listed in the cost principles and the selected items of cost, but we don't have then an extensive list for the purpose that there's always some exception. A scenario is going to, if we just start listing things that are unallowable, there's going to be a situation where that particular cost is actually necessary and there is no prohibition, on allocating it. So we don't have some extensive list beyond the things that are in the cost principles. You always want to revert to, so first take a look at what are the program regulations. Is this, unallowable based on our program regulations? Is it unallowable in our FOA? And then you can go from there to the regulations, the uniform guidance. Is it in the cost principles, selected items cost is unallowable? And if you can't find it explicitly listed as unallowable anywhere, then you apply those general tenets of allowability. Is it reasonable? Is it necessary? Is it allocable? So does it support the goals and objectives of the grant? Is there benefit received? Then you can allocate or charge it to the grant. If you have a question, we do ask that you always do your research first yourself. Because as your FPO, we have the same resources available to us that you do. We all have access to the uniform guidance. We all have access to the FOA. We all have access, if applicable, to program regulations. Let's do our own research. And then if there's any question or you want further confirmation, that's when you go to your FPO. And I would phrase my email, I found this citation in the regulations, this doesn't appear to prohibit, or it does. What we add as your FPOs is some historical reference, some historical understanding of certain costs. The graduation is one that's for example, where we can add, we might be able to add some historical context. But if you think about it, we want to buy food, we want to pay for like a hall, we want to buy tassels and gowns and all this stuff. Do those costs actually help somebody get trained and employed? Or do they further some deliverable in your grant? The answer is no, with or without your FPO telling you that, or the grant officer. So you really can arrive at a lot of this on your own if you understand the regulations. Next, will the slides be available? Yes, we can provide the slides to everybody after. I'll send them out to all the FPOs and they can send them to their to their individual grantees. When and how can an indirect cost rate be negotiated? What is the timing to negotiate this rate? So the question as an organization that you need to ask yourself if you've never had an indirect cost rate agreement is, would it be more advantageous to our organization to negotiate an indirect cost rate agreement with our cognizant agency? That's our agency, federal agency that gives us the most amount of money. Or would it be better just to elect to use the de minimis and modify total direct costs? I would just say that, as a big organization, well, I don't even want to use size anymore. It takes some work to develop an indirect cost rate proposal and submit it, and then you have to negotiate every year, and you have to go back to your cognizant agency, and they issue provisional rates and final rates. There are costs associated with just getting an indirect cost rate agreement that you wouldn't have if you used the de minimis rate. However, I can't tell you that it would be better for your organization to use the de minimis rate because I don't know what your indirect cost pool looks like. Really, the right answer would be that you negotiate an indirect cost rate agreement with your cognizant agency. You use it over, say, 5 years, maybe less. And then you could take a look at all that financial data from those previous years. And instead of using the rate, the indirect cost rate agreement that you were given from your cognizant agency, you would use the de minimis and see how it came out. Would we have recovered more if we had been using the de minimis all along, or do we recover more with a negotiated rate? We also have to factor in the amount of staff time that it took, dealing with an indirect cost rate agreement. So it's kind of a difficult question, but you can, in your grant agreement, there's the section up front that talks about, do you have an indirect cost rate agreement? You have to check that off and then submit it as part of your proposal. Or it says, no, we elect to use the de minimis, or I think there's the third option. We're going to submit one to our cognizant agency for negotiation. So with DOL, we have an Office of Cost Determination, and that's listed in our grants. And that's who you would contact if DOL gave you your majority of federal funding to negotiate an indirect cost rate agreement. If HHS gives you the most funding, ask your HHS contacts. Hopefully it's in their grants. If it's not, ask your project officer from HHS, how do we negotiate an indirect cost agreement with HHS? And they'll usually be able to give you instructions. Or if not, you just elect to use the de minimis. I think that especially with the new rate of 15% and being able to use up to the first $50,000 of every subaward, it's a pretty fair deal overall. I haven't done a ton of analysis of what would work out for organizations better, but using the de minimis is to reduce overall costs to organizations of dealing with that process. So next question, how do we shore up or recoup indirect charges with actual indirect costs if we find that the indirect charges are higher than the rate provided? Unfortunately, that's not the way it works. So the way indirect works is that it is a reimbursement. So and it isn't based on actual costs. So, it basically, it's an approximation based on this rate. And so that's why the negotiated rate is used, because they do look. What's that?
We can't see the screen.
Okay, yeah, this screen doesn't really have anything right now pertinent.
Oh, okay.
It's just like the question and answer slide. So the sorry, what was I talking about here? The indirect recovering charges. So yeah, if you're negotiating an indirect cost rate agreement, that is over time why that concept exists, because like say they give you a rate of 15% of personnel, and then in the next year, when you submit your indirect cost rate proposal, you would submit a list of all your indirect costs from the previous year. And then if they see that your indirect costs were actually higher than what you were reimbursed for, they may raise your rate for the next year. But they're not paying your indirect costs from previous years. It's just they'll adjust the rate up. But that's true also if your indirect costs go down in the next year, they're going to lower your rate for the next negotiated rate agreement. In the case of the de minimis, it's just going to come out maybe higher in some years than you had for indirect costs and maybe lower in others. But there's no like we then are paying dollar for dollar. It's a reimbursement. So kind of like if this is the example that I always get from my colleague Emily at the Office of Cost Determination. If I have roommates and I'm living in an apartment and it's my job to pay the cable bill, they're gonna all give me their share of the cable bill, and then I'm gonna just pay the cable bill out of my own funds. But if I don't pay the cable bill, then that's on me. But the other people paid, it's not a dollar for dollar. Like I take my roommate's money and then I give my roommate's money to the cable company. It's just going into my account and then I'm paying bills, so indirect costs do actually, in a sense, become, or I shouldn't say the costs, I should say the reimbursement does become like unrestricted funding because it's done in a reimbursement basis. You're paying your indirect costs. You're paying for your CEO. You're paying potentially for your fiscal office. And then you're collecting through this through this methodology after the fact reimbursement. But you could just pay for those costs out of your own funding. And then, you use the money you got from indirect to pay for something else, that's up to you. But your indirect costs are going to have to get paid somehow, right? So either it's going to have to be with your own funds or from the money that you get from your different funding streams. So that's a long answer, but there's no kind of like truing up of your indirect costs, dollar for dollar. Is my A133 audit expense allowable if the only reason for the audit is due to the DOL grant? Yeah, so, basically you have to have the you can have your own audit done depending, no matter what amount of funding you get. However, the federally required audit is required if you have a particular amount of federal funding in a year. Used to be 750,000. I think it's gone up to $1 million. Someone can correct me if I'm wrong, but I think it's if you spend $1 million in federal funds in a fiscal year, you must get the federal audit. And if you're an organization and your only federal grant, so the only reason you're getting the federal audit is because of this grant, then the total amount of that audit expense can be charged to that grant. You know, if you're getting grants from HHS, HUD, DOL, and even if DOL was the majority of funding, if all the different funding added up to over $1 million, you would just allocate the cost of the audit amongst the different grants. But if that's the only grant, then that's the grant that gets the charge. Somebody asked to put the resources slide back up. I can do that. I just lose my, I think I can see this at the same time. Oops, that's the questions. So the resources, it really just says the uniform guidance. One thing that I always mention to grantees, it's good project management, is to bookmark these, the ECFR with your web browser, because that is what is always current. You'll see when you click on the link, it says current as of that day. So if they make any little changes, you know that's most up to date. If you're using like the hard copies, or you're Googling it and you're pulling it off some educational institution website or somewhere else, there's a good chance it hasn't been updated. So the ECFR is the place where you want to go for these resources. But you can just Google 2CFR 200 and 2CFR 2900 and just make sure you're going to the ECFR. I got to get out of that slide just to be able to see the chat here. Someone asks, is there still a difference between a cognizant and a oversight agency? I don't, there may be some semantics there that, or a term that I'm unaware of. I think all federal agencies that provide you with federal funding have oversight responsibility. To what extent they do it, that can be variable. A cognizant agency is the organization that gives you the most amount of money in any given year. That said, what you might be getting at is there is a little nuance to this where, you know, an organization gets, you know, for 20 years, 18 out of those 20 years, they got the majority of their funding from the Department of Energy. And then in the last 2 years, they've gotten the majority of their funding from DOL. You would still probably go to the Department of Energy, because that might be what you're referring to as the oversight agency, because they've really been your major funder for the longest amount of time. I mean, if then those grants really wind down and DOL becomes your major funder over time, then you would want to shift to getting your indirect cost rate agreement from us in that case. But that question comes up. People are like, well, in 1 year I got the most funding from HES. The next year I got the most funding from DOL. Do I have to like jump back and forth with who I'm negotiating? And really, you know, we that's not the case. We're using kind of who gives you the most amount of money over time. That might be what you mean by oversight agency. If not, Sal, shoot me an email and I can get, you know, more, dig into that question a little bit more. Slides will be available. So somebody asks, is charging time to a cost pool allowable? If so, is the number of participants served an allowable base so long as the participants are participating in the same program? So we kind of have a couple different concepts in this question. time can be charged, time, fringe, corresponding indirect can be charged to a shared direct cost pool if it is difficult to determine the benefit received of that individual's work to the different grants. So, they're running around from this grant to that grant. They're going to different meetings that benefit, multiple grants at once. And we're like, it's getting too hard for this person to keep track, down to the hour, which grant is benefiting from their time. So we're going to take their salary fringe, we're going to put it into an indirect cost pool. And then we have to think about what is the best methodology for distributing that person's costs to the different grants. I mean, even if we bought them like supplies or travel, it would all have to go in that pool as well. And then we have to figure out, what's the best methodology for distributing all their costs to the different grants. It doesn't have anything to do with participants serving in the same program. We're just using it as a distribution methodology. So if the person works on participant heavy grants, number of participants in that program would be a good methodology for distributing their costs. But say that person is running around from grant to grant, but these are research grants, so there are no participants really in them. Well, then participant wouldn't be the best distribution methodology to approximate the actual benefit received, right? So what would be a better methodology to use in a research grant, in an organization that is just dealing with research grants, and you have a program manager running around from research grant to research grant? It could be number of, topics that are being researched, or number of products that are being developed in each of those grants. You have to just come up with what is the best distribution methodology that would approximate if they were actually charging their time based on benefit received like a lawyer would. Next question, for modified total direct costs, exclusion of rental costs, does that mean rent specifically, or utilities and other expenses related to use of that space as well, like snow plowing? So, we gotta just look back at the definition of modified total direct costs. And what it says, I'm just going to go to that slide here. Hopefully I'm still, maybe I wasn't sharing my screen. I'm going to share my screen. Modified total direct costs. Right there. Oops. So it says it excludes rental costs. So it doesn't actually say what rental costs are, if that includes just the, the lease bill, or does that include the utilities associated with that rent. So it would really be up to you to make that prudent person decision yourself, if those costs should be included in the base or not. You could always ask your federal project officer, and they could take your question to the grant officer and get you a definitive answer. But it is going to be still based on judgment when we all have the same definition to look at. It says rental costs. So, oftentimes utilities might be just included in the cost of the rental of the space. So in that case, yeah, then the total amount is excluded. I guess you could also make the argument that you're in renting the space, if utilities aren't included, you have to pay utilities. So that is a cost associated with the rental. And it doesn't just say rent, it says rental costs. So, and then we have to think about back to the fact that things are excluded for a reason, right? We're talking about indirect costs. So we are reimbursing you for organizational costs, things to keep your organization running. So the electric bill of the president and fiscal office, yeah, we can't allocate that necessarily directly to different grants because it's hard to say that the electricity for the fiscal office and the president's office helped anybody get trained or employed. But the organization can't even function or run if the electricity isn't on there. So we would include utilities costs in our base here because that's something that you should go into a base and be reimbursed for. I think the concept is that rental costs, you're paying the utility at some external space. So that isn't an organizational cost for you. That doesn't help keep your organization going. Therefore, that's why that's most likely why that particular cost is excluded. That's just of understanding the concepts. That's my rational thought. Don't quote me on that, but personally, if I was an organization, I would probably also exclude those utility costs that were for a rental space from my base, just for the reason I just mentioned, because that seems like the best line of thought. But, if you did include them, it doesn't say explicitly what rental costs include. So maybe you wouldn't lose that case if it went in front of an administrative law judge, or maybe you would get a question costs because an FPO, did make the determination that they think that should be included and the grant officer agrees. So again, this is some of the art of this. When we don't have black and white definitions for every single thing, we have to look at the concepts and then use our best judgment. I would say it would be best to err on the side of safety by excluding things. Again, rental costs. It doesn't just say the rent. So, but that's a great question. In a pure capacity building grant, is the cost of a warranty that extends beyond the term allowable, given that the use of this capital equipment itself is beyond the term? That's a great question as well, and one that I have researched extensively, especially in some of those old programs that were heavily capacity building. And we came to the conclusion that that's fine. Say you're gonna buy, I should say it depends. If you have to pay up front for I don't want to use a warranty. Let's use insurance as an example, which in a sense, I guess, can be the same thing. But if you're purchasing insurance for a piece of equipment, and we were actually require that you have insurance for your equipment in the same way you would for all of your other capital items. The term of that insurance can go beyond the period of performance. and the grant could pay for it in its entirety if it's an upfront payment that you must make to get that insurance. However, if the terms of that insurance are that you pay, say, monthly for the insurance, you would stop payment out of the grant the last day of the period of performance. You can't, we're not going to reimburse you or give you any more funding for the insurance after the grant ends. So you would need to start picking up the cost of the insurance for that equipment after the end of the period of performance. But if it was like some warranty that you had to buy up front that did cover, happen to cover past the grant period, that's fine. That's just like you say in your example, equipment that you purchase may still have value to the program after the grant's over. That's fine. But we're not going to pay for it after. So one thing to hit on there is that is a great question because it's something that organizations need to consider when they're buying equipment. Like, will your operating budget, if you're buying some very expensive lathe or CNC machine or something, is your organization going to be able to help pay for the maintenance costs and the insurance costs after the life of the grant? Because you can get an audit from OIG or another audit at any time after the grant period of performance. And if you're, not using the equipment appropriately, or if it was broken and you could end up still owing money back to the federal government. So make sure that you have the ability to pay for things beyond the term of the grant. Someone asked, what if there is funds left over at the end of the grant? What happens with them? Leftover funds, or should we make sure to use them all up? So that's a good question. Just use up funding, because those wouldn't be, there's not a benefit received necessarily. So what if you have met all your goals and objectives of your grant and you haven't spent all the money, that's great. Thank you. You have come in under cost. That money needs to go back to Treasury then. We can't buy supplies at the end of the grant. We can't just, keep paying for staff when the grant terms and conditions have been met and the performance has been met. So we can't just use up funds. You use the funds that are allocable to achieve the goals and objectives of the grant, and then the use of the funds stops regardless if there is a surplus. There may be some cases where you can forecast a surplus of funding earlier in the period of performance. I should say a forecast of underspending earlier in the period of performance. And in that case, we may want to do, like, say, a statement, or scope of work modification to add some activities that would support the goals and objectives of the grant to use that funding. So we're not just, using it up, but there were other things that we could have done under this project to support the goals and objectives and to help our participants. And we can forecast a surplus of unused funds for whatever reason. And so we maybe do a scope of work change and add something that benefits the grant. But we don't hit, later in our period of performance, we've met all the terms and conditions, and now we go buy supplies or equipment, or we just pay our staff to basically do nothing. Those would be non-allocable funds, and you could get all those costs questioned or disallowed during an audit. Next question, for clarification, when you refer to subawards for the modified total direct cost, does that only refer to subrecipient agreements, or does that include contracts as well? So that question there is a very good question, and there's been a lot of debate at the federal level. And I don't know that we 100% have a definitive answer. My personal position is we go with what the actual definition says. So it says a subaward. So that really, when we look at the terms in the uniform guidance, we have subawards that are for subrecipients, and we have contracts that are for contractors, that have to be procured. So in my view, the term subaward then means that it should be for only subrecipients and not included for contracts. There was, so I think the definition did say there was used to say something a little different, and so I think both could be counted, but I believe now the most of the consensus is that it should just be for subawards under subrecipient agreements. And I have actually heard that from the Office of Cost Determination. That's their position as well. And then we can go back to, the overhead question again, and, should you be getting, are there organizational costs associated with contracts for subrecipient agreements? But if you want a definitive answer on that question, ask your FPO, and we can see if we can get the grant officer to tell you one way or the other definitively. Next question, back to the idea of costs allocating staff across multiple funding sources. What if all participants are co-enrolled and the goals, deliverables of the grants are in alignment? Could you then allocate staffing based on grant funding? Speaking only of, no, we can't allocate to overall projects. We have to allocate specifically to grants and those funding sources. The co-enrollment of participants doesn't matter. That doesn't have, when we talk about participants, when it comes to allocation, that's just a methodology for distributing costs. It's not like an element or a term of distributing costs. It's just a method. It's a general methodology to approximate actual costs. So you can't lump grants together. That's what they call like commingling or braiding, or it can feel difficult to do this when different grants are so aligned in their priorities and what they're doing, but you really have to keep them separate and allocate to them based on the benefit received. Now, if you have staff that are working on 2 grants, and there really is a lot of, the benefit received is really hard to determine on an actual basis, you could take all of those folks and stick them into a shared direct cost pool, and then allocate the costs based on a methodology that is most appropriate. That could be number of participants. And if they have the exact same, you're going to serve 50 in this grant and 50 in that, then yeah, I guess it would come out that you would charge all those costs 50-50. But most likely grants aren't going to align to that extent. One grant's going to have a different amount of participants in it than another. And I think this is something to be careful, especially in the youth build program, because you guys you'll get a grant, and then, you'll be operating that grant, and then now you get a second round of funding. Maybe there was some gap in there, and now you're thinking, well, this is all the youth build program. How do, these costs benefit both, but you can't do that. You can't allocate to an overall project. You have to allocate to the specific funding stream and look at where those costs are benefiting. And then if it's really hard to figure out how they're being, the proportions they're benefiting, then you can use some other methodology to approximate the benefit. Someone says if program staff complete 50 hours of work on one grant program in a single week, but they are a salary employee and does not earn overtime as part of their compensation package, to report costs for 40 hours or 50 hours in the grant reporting. The question is, are the extra 10 hours worked an allowable cost, even those that aren't a specific cost payment attached to the extra hours? They have value, but are they allowable cost? So we do have a whole presentation in the SMART training on personnel compensation. It's one actually I did years ago. Hopefully it's still in the list. If not, maybe that's a good topic to add to our list. I'm going to add it right now. The answer with this one is to get a definitive answer, you want to go to your FPO with this, because we need to get all the relative details to make sure that we give you an accurate answer for your particular scenario. If I just give some general, the general answer, I am afraid that for others that are listening to this, there may be some small detail that is a variance that would then make it unallowable. So I'm a little hesitant to give an answer on this. So you want to reference the overtime, look in the cost principles. You want to reference, what is your organization's policy and procedure on overtime? And I'll just give you that as a starting place. And from there, let's get that question to your FPO and we can get you a definitive answer. We got 3 minutes left here. CFR regulations were referenced. Does youth build funding from DOL require annual CFR filing? I'm not sure exactly what that question means. CFR is the Code of Federal Regulations. Youth build funding has the program regulations. They have their own, I don't know if that CFR filing, if you mean audit, that would be for, only if you have over $1 million of expenditures in a single year would you need to file an audit. So I would say normally open up and give me a little more detail on that, but because we only have so much time left, how about send that email to you, send that question to your FPO and we can dig into it and get you a definitive answer. And that looks like the last question. I don't know if anybody has a question they didn't put in the chat. We do have a couple minutes left. And if you want to unmute yourself and ask a question, I'd be happy to go a few minutes more for anybody that wants to stay. If not, feel free to exit the session. Any other questions out there? Right, so we got next month, I think we're trying to decide what session we're gonna do next month, but be on the lookout for our training for April for Region 1 grants management training, and get any topics to your FPOs. And thank you for attending.